Today, we are focusing all our attention on Reviva Pharmaceuticals. That's ticker RVPH. And this is one of those stock stories where, the technical charts just woke up with a roar.
They really did, after months and months of just sideways trading.
Exactly. The stock recently pulled this sudden, sharp move, a near 7% gain in just one session.
Right.
And the analysis report we're digging into is asking that critical question. Is this the start of a major reversal?
It's such a classic setup. The kind that gets traders buzzing. RVPH had been trading low, finding what looked like a durable bottom.
And then boom.
Yeah. When you see a jump like that, it's not just noise. The analysis frames it as a potential reversal signal.
Okay, let's unpack this.
Yeah, we're here to dissect the data points that suggest this stock is, truly waking up. And more importantly, figure out if this massive valuation gap that Wall Street is calling out is even realistic.
Because the projections attached to this wake-up narrative are, frankly, unbelievable. Our mission here is to understand the technical factors that cause the immediate lift. And then, crucially, how analyst projections, suggesting up to 500% upside, fits into the current valuation of a stock trading for, pennies on the dollar.
That dissonance is exactly why the analysis is so compelling.
Right. We need to grasp these insights quickly because there's a serious disconnect here.
There is. We're connecting immediate market action, this tiny jump, to the long-term high-stakes potential of their drug pipeline. The technical move, it validates the timing, but the fundamentals have to justify that target.
So let's start right where the action happened. The report details the specifics of that trading day. The stock opened at, 32 cents?
Opened at 0.32, closed at 0.33.
Securing that plus 6.97% gain, which is respectable, but not earth-shattering on its own.
Right. On its own, no. But the analysis focuses on what happened during the day.
The intraday action.
That's what tells the real story. The stock traded down sharply. It hit a low point of 29 cents.
And the analysis report specifically labels that dip a bear trap.
It does, and that is an incredibly important technical signal.
A bear trap. That implies a false signal, right? The price drops just low enough to lure in sellers who think the stock's finally breaking down.
Precisely. It was a test of psychological fortitude. That 29-cent mark, that represents a crucial, established support level, a hard floor for a lot of traders.
Okay.
And when the price tested it, instead of collapsing under selling pressure, aggressive buyers stepped in. Immediately.
So they saw it as an opportunity.
They saw it as an opportunity to buy cheap before the bounce, not as a sign of weakness.
So they rejected the downside. And the key isn't just surviving that test, it's how the stock finished the day.
Absolutely. The fact that RVPH closed near the high of the day at 33 cents after surviving that 29-cent test, that is the definition of classic reversal behavior.
A profound shift in momentum.
Exactly. The market tried to push it lower, it failed decisively because of conviction buying, and then it rallied. That tells us the immediate downward pressure has been rejected, and momentum has shifted back to the bullish side.
The technicals are basically signaling, I found the bottom, I'm ready to go higher.
That's it. It sounds like the analysis is suggesting the easy money on the short side is over.
So this sets the technical stage for the really big story.
It does. It moves the stock from the sideways and consolidating category into the active and reversing one. The technical rationale is solid, but those price targets we're about to discuss, they require a lot more than just a reversal candle.
Yeah, that technical shift is great, but charts alone don't power a stock up 500%. There had to be an immediate fundamental reason for that conviction.
There was.
Here's where it gets really interesting. What was the catalyst?
The catalyst was fresh analyst coverage, and it dropped right before that surge. We're talking about Chardin Capital. They issued a new strong BUI rating on Reviva.
Okay, analyst coverage always moves the needle, especially for a small cap biotech.
But it was their price target that really created the frenzy.
All right, let's break down the math for everyone listening because it is staggering. Chardin applied a $2 price target.
$2, right.
Yeah.
So if you take the closing price of 33 cents, a move up to $2 represents a massive potential return, around 500%.
500%.
This is not a typical upgrade. This is a declaration that the current price is wildly mispriced.
And Chardin isn't even the highest. The analysis mentions H.C. Wainwright maintains targets as high as $4.
That's great.
Wait a minute. The stock is at 33 cents, and these experts are putting out a $4 target. Doesn't that just sound like, pure speculative hopium?
It's a fair question to ask. What's the rationale behind a 12x return?
Yeah.
If we connect this to the bigger picture, what these firms are saying is they believe the stock's current price reflects none of the inherent value in the company's pipeline.
So it's all about the future.
It's all about the future. Wall Street clearly thinks this stock is deeply undervalued at 30 cents. They're making a high-conviction, high-risk bet that the clinical pipeline is worth exponentially more than the current market cap.
It creates this incredible dissonance. A stock trading for pennies, while sophisticated analysts are projecting multi-dollar valuations. That gap it has to be entirely based on the success of one or two key events.
It is. The analysts are banking on the fundamentals catching up to this technical reversal. The technicals confirm interest, but the fundamentals, they're what justify the price target. And this brings us right to their bull case checklist.
Right. Charts only take you so far. To get to $2, let alone $4, the analysis has to be banking on some serious business backing.
It is.
The report structures this case into a neat 4-point bull case checklist. Let's see what justifies that 500% confidence.
This checklist is a great way to understand the risk-reward calculation here. It's a combination of a low entry price, financial stability, and just massive catalytic potential.
Okay, let's hit point 1. Valuation floor. The report notes the stock is trading near its 52-week lows. That current price of 33 cents is a stark contrast to its previous high of $2.17.
And this is critical for managing risk. It implies the froth is gone.
All the hype.
All the speculative excitement, the euphoria, any previous retail spikes, it's all been flushed out. You are buying at what the analysis calls the floor. When a stock trades this close to its 52-week low, the downside risk, at least technically, is often significantly reduced.
Okay, now let's talk about the real rocket fuel. Point 2, phase 3 pending. This is where that 500% valuation comes from, right? We should probably spend some time here.
We absolutely should. The core of Reviva's potential value is centered on its lead drug, brilaroxazine.
Brilaroxazine.
Yeah, this drug is designed to treat schizophrenia, which is a massive global market with significant unmet needs. They're currently gearing up for the RECOVER-2 phase 3 trial.
So what makes brilaroxazine so important? I mean, what's it potentially doing better than what's already out there?
That's the hook. Brilaroxazine is differentiated because it's targeting multiple neurotransmitter systems. It suggests a novel mechanism of action. The hope, which is backed by earlier data, is that it could offer better efficacy with potentially fewer severe side effects.
And for patients, that would be enormous.
Enormous. And for the company, a successful phase 3 isn't just a clinical milestone. It opens up a multi-billion-dollar market opportunity. That scale of opportunity is precisely why analysts are willing to stake a $2 or even a $4 valuation on a 33-cent stock.
So the analysts are essentially looking at this enormous potential market size and just factoring that into the valuation today, assuming a positive outcome. It's a massive binary bet.
It is, and the anticipation of RECOVER-2 is the shadow catalyst looming over the stock price. Any positive news from that trial will power the stock far beyond 50 cents.
Okay, moving to the third point on the checklist, which addresses stability. Cash runway. Because even a great drug needs time and money to get to market.
Stability is paramount, especially for a small biopharma waiting on critical data. The good news here is financial safety. Reviva ended the last quarter with over $13 million in cash.
$13 million doesn't sound like a ton compared to a pharma giant.
It's not, but for a small biotech preparing for phase 3, that's their life jacket. It means they have the necessary runway to execute their immediate plans, including the preparation and launch of RECOVER-2, without immediate existential funding pressure.
So no need to dilute shareholders tomorrow.
Exactly.
And finally, the fourth point, low float volatility. This helps explain why we saw that near 7% move so quickly. It's the trading mechanics.
This speaks directly to how the price behaves. RVPH has a market cap under $40 million. In relative terms, that is tiny.
Tiny.
A low market cap often means a limited supply of publicly traded shares, the float, so it doesn't take much volume to create these sharp, dramatic moves.
Give me an analogy. Why does a low float make the move so volatile?
Well, think of it this way. Moving a massive cargo ship takes an enormous amount of thrust and momentum, right?
Yeah.
But moving a small canoe takes very little wind or paddle effort to send it surging forward. With only a $40 million market cap, RVPH is definitely a canoe in the ocean of the market.
That makes sense. That's why a single day of conviction buying, even if it's modest volume compared to larger stocks, can create a near 7% ripple.
And that makes the overall picture clear. You've got a low entry price, financial stability, a massive clinical catalyst looming, and a market structure designed for sharp upward movement once conviction takes hold.
It's a compelling checklist.
It is. It connects that financial stability to the low entry price and combines both with a high impact near-term catalyst. It justifies the analyst's high conviction, even with all the risks.
So now we need to shift gears. Let's focus on the immediate trading environment. For anyone watching this stock now, what specific technical metrics are required to confirm that this reversal is actually the start of a sustained breakout, not just a one-day bounce?
You need to monitor two things: support holding strong and key resistance breaking decisively. The price action has to confirm the underlying interest.
Okay, support first. We mentioned the 29-cent bear trap. What's the crucial support range that absolutely must hold?
The analysis is very clear on this. 29 to 30 cents is the hard floor.
The hard floor.
If the stock pulls back to that level and holds repeatedly, the report identifies it as a solid entry zone. If buyers step in there again, it confirms that the bears are truly exhausted at that price point.
And the reversal pattern remains valid.
It does.
And what about the ceiling? What level must RVPH surpass to prove this breakout is real and sustainable?
That crucial resistance level to watch is 35 cents. That's the immediate psychological barrier.
35 cents.
Yeah. The analysis states that if RVPH breaks decisively above 35 cents, and this is key does so on high volume, it signals a technical green light. Breaking that could lead to a very quick run toward the next major resistance, which is 50 cents.
And volume is the confirming ingredient here. We know the reversal day saw 7.6 million shares traded, which is much higher than average. Does that volume need to continue?
Absolutely. That high volume indicates conviction on the day of the reversal. But the analysis stresses that we need to see that volume stay high in the coming sessions to truly confirm this is a sustained breakout.
And not just a short-lived reaction to the short end news.
Exactly.
This raises an important question, though. We focused a lot on the potential 500% gain, but biotech is binary. What happens if the reversal fails? What does the analysis say about the downside if that 29-cent support gives way?
That's essential to consider. If the volume drops off sharply, it suggests the move was purely reactionary and the stock is likely to just settle back into its sideways pattern.
Back to waiting.
Back to waiting. More critically, if that 29-cent support is breached, the entire technical reversal thesis is invalidated. In that high-risk scenario, the stock would face the possibility of retesting its all-time lows.
And renewed fears about cash burn and future dilution would probably drive the price lower.
Without a doubt. High reward always comes with serious downside risk in this sector.
So, sustained high volume and holding 29 cents suggests conviction. Falling volume or failing that level suggests the quick money is gone and we go back to the wait-and-see game.
Precisely. Sustained volume suggests that new traders and institutions are entering based on this undervaluation narrative, which is the necessary fuel to power a move from 33 cents to 50 cents and beyond.
So what does this all mean? Let's sum it up. We've seen a significant technical reversal defined by rejecting that 29-cent bear trap and closing strong. This move is backed by massive analyst targets, from $2 all the way up to $4, and it's supported by a crucial fundamental checklist.
Trading at the valuation floor, having a solid $13 million cash runway.
And most importantly, preparing for that high-impact Phase 3 trial for brilaroxazine.
The takeaway from the analysis report is that after finding a bottom and enduring months of sideways trading, the data suggests we might be witnessing the bottom pivot right now.
The charts are waking up.
The charts are waking up and the analysts are providing the valuation map for the road ahead. And it's predicated entirely on the clinical success of brilaroxazine in that massive schizophrenia market.
That roadmap is huge, but so 3 cents and that high analyst target of $4, the analysis is clearly banking on a game-changing outcome.
It is.
That makes you wonder, what specific clinical metrics, what level of efficacy or reduction in side effects in that RECOVER-2 trial would be absolutely necessary to bridge that valuation gap, to turn that 33-cent floor into a solid $4 ceiling?
That is the core question.
It is, and it's the question you need to be tracking in the months ahead.
It is a high-stakes bet, entirely dependent on proving the clinical value of their lead asset.
Indeed. We encourage you to track those RECOVER-2 trial details.